Next, we're going to take a look at how a merchandiser accounts for sales transactions. So remember, a merchandiser sells goods, and now we're going to take a look at how they would account for when they sell their goods. Whenever a merchandiser sells their goods, there are two transactions that we always have to account for. So again, for every sale, there are two transactions that need to be recorded. Let's say that a retailer sold a box of cereal. The first transaction they will record is the sale. So they're going to record the sale, and they're going to use the selling price of the item to record the sale. The second transaction they're going to record is the reduction of inventory. When they sell the box of cereal, they have one less box of cereal in their inventory. So we've got to record that one as well. To record this transaction, they're going to use the cost of the box of cereal. Again, they're going to use the cost of the item to record the reduction of inventory. Let's take a look at some examples next. First, let's take a look at the sale. On May 1st of 2014, Elmer's Glue Inc. sold $5,000 of glue on credit. The cost of the glue sold was $3,000. Remember, for every sale, there are two transactions we need to record. The first transaction is the sale. How much did they sell it for? They sold it for $5,000. The two accounts affected by this transaction are sales revenue and accounts receivable. Accounts receivable because we sold on credit. If it was sold for cash, it would be sales revenue and cash. We know that using the rules of debit and credit, that when revenue increases, we're going to credit revenue, and when accounts receivable increases, we're going to debit accounts receivable. So your journal entry for this is debit accounts receivable, credit sales revenue on May 1st. Remember, that's only the first part of this transaction. There are two transactions, so that's transaction one. The second one is to record the cost of the glue that was sold. So we sold some glue, $5,000 was the selling price. How much did the glue cost Elmer's Glue Inc.? It cost us, the company, $3,000 to buy it from our supplier. So now we've sold it, we need to remove it from our inventory. So we're going to remove that from inventory, and that goes into an account called cost of goods sold. So the two accounts affected by the second transaction are cost of goods sold and inventory. Now, which account gets debited, which accounts get credited? Cost of goods sold is an expense account. Our expenses went up. Our expenses went up by $3,000, so we are going to debit cost of goods sold. Now let's take a look at inventory. Inventory is an asset. Asset decrease. When we sold our inventory, our assets went down by $3,000. When asset decreases, we are going to credit it. So on the 1st of May, we're going to debit cost of goods sold for $3,000 and credit inventory for $3,000. These are the two transactions that will always take place whenever a merchandiser sells inventory. To recap, cost of goods sold is the cost of the inventory. It's the price that we purchased the inventory for, and cost of goods sold is an expense account. In a merchandiser's income statement, you will have your sales revenue, so your sales revenue of $5,000. Then you will have cost of goods sold, which is an expense which you subtract, and then we end up with a calculation called gross profit. Gross profit is $2,000, which is $5,000 minus the expense of $3,000. And then all your other expenses such as rent, salaries will get subtracted from this gross profit, and then finally you will end up with your net income calculation.